Okay, good day everyone. This is Capital Air Integrated Commercial Trust First Quarter 2025 Business Update dated 25th April 2025. Alright, we'll look at the executive summary. Okay, first quarter gross revenue and NPI marginally eased, which means drop. Right, largely due to absence of income from 21st Chloroquine, which was divested last November. Right, on a like-for-like basis, first quarter 2025 gross revenue and NPI were up by 1.1% and 1.4% respectively. Right, contribution from joint ventures such as Iron Orchard, which was a recent acquisition, is only reflected at the distribution income level, right, and therefore is not added to revenue and NPI. Right, so these numbers are not affected by Iron Orchard's addition. Portfolio NPI margin was 74%. Okay, we observe higher signing rents for new and renewed leases compared to rents of expiring leases for both retail and office portfolio, so that's a good thing, but occupancy is marginally lower. Right, healthy financial position. Right, leverage is below 40%, 38.7%. Right, and average cost of debt we're very happy to see has gone down to 3.4%. Okay, down from December, which was at 3.6%. In fact, the last two quarters was 3.6%, right? So it plateaued and now it has finally come down, right? Which is something we're happy to see, right? Probably the best report of this, best news of this report, rather. Right, so NPI we discussed already is actually down marginally, 0.8%, right? For first quarter this financial year versus last first quarter in 2024, right? For like basis, but actually it's at 1.4%, okay. Aggregate leverage is up 0.2%, very slightly. Right, cost of debt is down 0.2%. This is what we're happy to see. Right, financing at 3.088%. Right, this is good. Right, because anything below the average cost of debt is good. It will bring down the average cost of debt. Right, occupancy is still high. Right, so not super worried about it. 96.4%, and I think most of the vacancies actually just come from the overseas part of the portfolio. Right, not much to say. Rental revision looks good. Retail is up 10%. Right, office is up 5.4%. Right, so pretty good numbers. Right, so tenant sales, we see first quarter 2025 up 17.5%. Alright, but later we look at the details. Right, this looks very good, but it's not as good as this. Alright, I'll show you why. This may not be that reliable to look at. Okay, so yeah, actually there's partly here. So they already said that excluding Iron Orchard, tenant sales actually fell by 0.5% year on year in first quarter 2025. So actually it's a drop, right, as if you exclude Iron Orchard. Right, the details we'll look at in a bit. Right, so yeah, this one we already discussed. So I'll take it as a flattish performance. Either, even you take the actual performance is down by 0.8%, I'll take it as just flat, primarily because of the loss of one property, right? Right, in the near future, very little debt, 14% due in the next 2 financial years. Right, then this is where the risky part comes. We'll be a bit more worried about this 38%. Hopefully interest rates are lower by this time, right? But this is something that is very unpredictable, right? This has been predicted for the last 1 or 2 years with pretty poor results, I would say. Right, aggregate leverage is quite low, right? Fixed borrowing on fixed interest rates going down, which I think is a good thing, right? Because interest rates in general are going down, right? Interest coverage ratio went up to 3.2x, right? Which is a good thing, right? Cost of debt down, right? This is what we're happy to see, right? Ratings by Moody's is still quite strong, no issue here. Right, quickly look at the performance, so you can see in terms of the type, retail is very high, alright? I don't think there's a significant drop here, alright, even though it's down to 98.8%. Alright, still very high. Office is a bit 5% vacancy, right? Below 95% is a bit of concern, right? But I think this is mainly overseas issue again, right? Integrated development, alright, generally doing well, right? One look at this. Yeah, so this is the lease expiries for retail side, 11.6%. Retail side is pretty strong rental revision, so we expect this to carry on in the near future, but it should drop. Alright, and I'll explain why in a moment. Right, office 3.9%. Right. Not going to go through this. Yeah, this is just the rental retention rate. Right, so yeah, this is the main slide I wanted to discuss. Alright, we look at rental revisions, right? Actually, it looks quite good. right? Overall is up 10.4%, right? But if you look at it carefully, right, this 11.2% is downtown and suburban is 9.5%. So actually both sides are doing well, right? But I think if you look forward, right, because of the sales results that have been coming in, right, this thing isn't long-term sustainable lah. I think the next few results will still be positive, probably 5 to 7%. Right, you can see what the management say here, projected to remain positive rental revisions, albeit at a more moderate pace in the next few quarters. That means they don't expect a 10.4% across in the next few quarters this financial year. Right now, the reason is because sales has not been very good. So you look at sales numbers, right, you realize that if you look at the retail portfolio sales number, it looks up 17.5%, but this is actually mainly due to Ion Orchard. Right, if you take out Ion Orchard, actually is down 0.5%. Right, so the 0.5% drop, downtown dropped by 0.4% year on year. You can see here, suburban dropped by 0.3%. Right, so actually this one I would like to compare with FCT which is a pure suburban mall. Right, hopefully they get better numbers than this. Right, I'll have a look at FCT's results probably in the next presentation. Right, and I'll try and explain to you why I'm worried about this drop in sales and why the boost when it's from Ion Orchard, right, is not so reliable. Right, so I look at the last presentation slides, which was I think sometime in January. Right, wait, let me check the date of this presentation slide. 5th February, yeah, so somewhere around there. Right, if you look at this data from where the boost in sales come from, it mainly comes from this part. Right, so this when actually last quarter I already pointed out that actually the year-on-year results, this FY 2024 results actually was down 1%, right, for downtown, and suburban barely up. Right, so the sales wasn't doing well in both suburban and downtown. This 8.8% rise is only because they had Ion Orchard. Right, and Ion Orchard, you look at this, this one was the main Ion Orchard effect. Right, the previous quarters did not have this. Right, so this thing pop up actually due to just Ion Orchard. And to me, things like jewelry and watches are discretionary spending, which means to say that if you got excess money, then you spend on this. Also, it could be overseas people coming in to buy shop at Ion Orchard and buy expensive jewelry and watches. How sustainable is this? I'm not sure. Alright, so discretionary spending in bad times, right, people don't spend so much. So I suspect Ion Orchard moving forward the next few quarters may not be able to do so well. Alright, that's just my suspicion. I do not have any information or data to corroborate what I say for now. Alright, but if you look at the tariff wars, right, the fact that the Chinese are actually they're definitely affected, right? They're putting on up a brave front, which is good for the Chinese people, but definitely with the stopping of orders from the US side because of the tariffs being so high, right? Even with the current ceasefire of the tariffs, it's still 30%, right? So I think nobody knows whether they should just import more things from China or they should stop completely. And a lot of factories in China, their production has stopped because the US side stopped ordering, right? So that's going to affect some of the rich people in China at least. And I'm sure the US side, some of the businesses have already reported that they have closed down, right? So I think I was listening to Scott Galloway's podcast, and he was talking about US side. Because of the tariff being so high, right, they cannot afford to pay, right? So they told the Chinese side to stop production, and that means that they just wind up the business, right? Some businesses 15-20 years, right, family run businesses, they just have to wind up because of these tariff things that is going on. So the repercussions have not been felt in the numbers in this set of numbers, both in the US and I think in this set of numbers as well for Singapore, right? But it's the next quarter's result that we have to see what the impact is, right? So I think going forward, CICT may be more volatile than it used to be, right? So that's the main takeaway I have for CICT. You can see that generally the gaps, right, come from Germany and Australia, so it brings down the overall portfolio to below 95%. But if we look at Singapore, it's all quite high, right? So it's almost 98%. The rest I think I won't really talk too much about. There's some URA upgrades at Tampines which should benefit Tampines more, right? Other than that, I don't really think there's too much I want to say for this presentation. I'm not going to look at the macro outlook. grade A office, yeah, I don't think there's too much to say about it. It's not that important to discuss all these things. Yeah. So yeah, that's the end. Office side, I'm a little bit concerned. Overall, in Singapore, there seems to be a bit of excess in office space. Even if you look at this data, it looks like there's a bit of excess. You can see that the demand in the last few years has been trending wrong. Right, 2023, the net demand was 0.3, right? Then become 0.2. Then looks like becomes 0. Right, I'm not sure if this is supply or demand. I think, okay, so this is the forecast supply in 2025, right? Forecasted supply, I think 0, right? But 26, you can see there's a pretty high supply coming up, right? And I think we're not sure about the demand, all right? So we'll see how that goes, right? But I do think that office space in Singapore seems to be in some kind of excess supply, right? Given the business parks coming out in Punggol and Changi business parks being pretty empty, and so, and even MBC from Mapletree Pan Asia side is not even fully occupied, right? So somehow office space in Singapore, there seems to be some kind of excess situation. So I'm not super optimistic about office space in the near term, right, for CICT. Alright, with that, I'll end the presentation. Thank you very much for listening. Do give me a thumbs up if you have found some value in my presentation. Alright, goodbye.